Last week, we looked at the opportunities or the road ahead for M&A and deal making. And what I want to do in this recording is to focus on private equity, venture capital, and in general the funding environment, but mostly focused on your private equity. I think what we have seen is the private equity industry faced some really challenging environments over the last few years, 2022 to 2023. And again, we saw high interest rates, which made leveraged buyouts more expensive. Exit markets, IPOs, etc., was really subdued, specifically after the 2021 high. And then fundraising slowed as LPs really digested some big commitments from the prior years. Of course, a few things have changed, and if you watch some of the earlier videos around the economic outlook and how 2025 played out, but also what we think about 2026, we can see that many of these factors have changed. So there is, I think, signs of really strong some strong signals of a cautious recovery for private equity in 2025 and 2026, specifically for your larger deals. So really, we're seeing that private equity appears to be on a cautious path of recovery, with I think some strong signs of really improved environment for bigger ticket deals. And again, but this was also driven, if we refer back to some of the sponsor-driven M&A activity that picked up in 2025. But private equity still has really plenty of dry powder. Globally, I think the estimates is into the trillions of dollars, which they are really incentivized to put to work and have to put to work. So as fundraising pressures are easing a bit, after really a dip, LPs like your pension funds, your sovereign wealth fund, etc., are gradually returning, especially to established private equity managers, because other asset classes, your bonds, your public equity, have become very volatile and also lower yielding. So again, a very interesting time we are facing for the year ahead. If we focus on briefly on deals and sectors, real investment focus areas for private equity in 2026 really mirrors some of the themes we already see play out in the M&A world. So technology deals, software, fintech, IT remain real favorites for your private equity funds. And this is really due to sector growth and recurring revenue model. So the business model being well suited for what they're looking for. Tech-focused PE funds raised in recent years also will be deploying capital, sometimes in very innovative ways, like growth equity stakes rather than full buyouts. We're seeing private equity targeting healthcare, so services, pharma, medtech, etc., given that it's very defensive and growth characteristics. And we see this continued interest in things like medical practice roll-ups and healthcare IT and even bigger pharma carve-outs and biotech, etc. Another area, and this has also probably been on the agenda for quite a few years, but it still remains high, is business services and industrial niches and consumer brands. So they are really um, key focus areas where PE tends to find value by improving operations and consolidating fragmented markets. And so these areas still remain quite a key focus. And then, of course, infrastructure and real assets. We see that some private equity firms have really specialized vehicles for infrastructure, or at least are teaming up with infrastructure funds to take private assets like utilities or transport assets that have more stable cash flows. And I think all around the world, if we see where geopolitical risk and agendas are moving, we're seeing a lot of infrastructure spend happening. And if we again refer back to the emerging markets, we're seeing a lot of that not just happening back in the markets, but required to build those economies further. One challenge that remains is valuations. Many deals done in the low rate era are now underperforming if they were over levered or potentially overpaid for. Um, but this also creates opportunities. So for secondary buyouts or sponsor to sponsor deals that arise, where a PE fund sells to another PE fund at a more reasonable price, effectively resetting the clock. Additionally, if corporates shed non-core divisions to streamline or to raise cash or to settle debt, PEs will be ready to really scoop in and take those up, often finding carve-outs as a value play by giving neglected businesses or non-core businesses the focus they really need. So valuation still remains an issue, although there's more certainty in that. And you can also look at my M&A video where I comment a bit about valuations. Now, a big contentious point is still the exit environment. For private equity to really flourish, the exit environment needs to improve. 2025 saw an uptick in IPOs, which is good to see. About 56 billion was raised in traditional and SPAC IPOs if we focus on the US, and this is the highest since 2021, sort of indicating that IPO windows is starting to reopen. But if stock markets remain constructive, 2026 could feature more PE-backed IPOs, specifically in your tech and biotech world. So allowing funds to realize gains and obviously return funding to LPs, which in turn boosts confidence and will help fundraising as well. Strategic acquisitions of private equity portfolio companies have also increased as corporates find it much easier to justify acquisitions, like your big tech firms buying PE and software companies. And again, if you look back at 2025, despite challenges, many PE firms managed to exit some holdings at relatively decent returns, just not at the frothy multiples that we saw in 2021, which obviously was, in hindsight now, an outlier. We're kind of sitting with levels that sort of looks like the norm prior to that. So for 2026, I think expectations around exits is probably moderate, but definitely improve relative to the level we saw. So I think exits might not reach the record pace we want to see, but definitely better than what we've been recently through. So I think this overall sentiment is gonna help for PE. It's gonna help PE raise more, invest more, hopefully exit and raise again. But we do need some more traction in this. Finding that exit means a lot. Of course, this also has a strategic impact if you're holding for longer, which has also been a rising trend over the last decade, is how do you now still create value and unlock value going forward, specifically if there's an obligation to also return capital and what that actually means. If we briefly look at venture capital went through a boom in 2021 and pretty much bust 2022 and 2023, but now have stabilized. 2025 data really shows that VC investment globally leveling off, and even there has been some growth in certain areas. But I think the main headline these days is obviously dominant of AI venture. I think something like 65% of total VC deals done in 2025 was AI related. So again, a truly big share, and again driven by mega rounds for generative AI startups and a general flood of capital into any company branding itself as AI. So as we move into 2026, VC investors, I think, remain very interested in AI, but more discerning, and if they're not, they should be more discerning. So I think we're seeing that the hype is a bit tempered and by some caution about valuations, but I guess the consensus is that AI will underpin the next wave of tech innovation from enterprise software to drug discovery, etc. So we cannot afford not to invest. We may see some bifurcation where very top AI companies get outsized funding at high valuations while lesser ones struggle to raise amidst this fierce competition. So it's very much a winner-take-most dynamics that will likely pay out. But it's also important to look beyond AI. So here too, climate tech, clean energy is key. Many climate startups require larger capital. So again, attracting venture growth and infrastructure structure funds, biotech and health tech, a key focus. And here too, you're looking at I think after a slightly slower period, biotech funding I think could pick up if public biotech stocks start recovering, and these sustained interest in areas quite broadly biotech, but like gene editing, AI-driven drug discovery, telehealth platforms, etc., become very interesting plays. And then fintech and Web3. Fintech is maturing. Some areas like payments are probably very crowded, but there's niches within that. So regulatory tech, insurtech, etc. Serving the underbanked in certain markets is definitely still growing. Web3 crypto venture funding definitely dropped after the 2020 crash, but a subset of believers remain. And if crypto market rebounds, funding again could follow. But I do think probably quite carefully because of the regulatory overhang. And then enterprise software and cybersecurity. I think these were really and are the bread and butter of VCs, and they are continuing. Enterprises always need software solutions, in particular anything that helps manage costs. So your SaaS that improve efficiencies, your security systems around cyber, is really going to get attention. If we take slightly a broader view, I think notably venture is definitely spreading across the world globally. The US still leads, but Europe has a rising VC activity. Strong hub exists in the UK, France, Germany, and also in the Nordics. The Asia VC scene, especially India and Southeast Asia, remain very active. Some are a bit cautious around China due to government crackdown on tech. The Middle East is an emerging VC source. Saudi and the UAE funds are backing startups. And then, of course, Africa's startups ecosystem on a global scale is still small, but definitely fast growing. Year two, focus on fintech, e-commerce, certain hubs forming in South and in North Africa. And again, off this pivot of a young population, a rising middle class of a population of 1.4 billion people, really a huge opportunity. So we should see that also developing. I also said, besides private equity and venture capital, I also want to talk about the funding environment or financing. So I want to briefly touch on capital availability and also then maybe your alternative funders or private credit, but just maybe just on availability of funding. I think as we move into 2026, a lot of VC funds raised money in 2021 at the peak when capital and still have capital to deployed. Limited partners have been a bit more selective in committing to new VC funds, preferring your more established managers or your thematic funds like climate, etc. However, if some big exits happen, so we need some successful IPOs, etc., that could boost the confidence and LPs could start allocating more again. I think one interesting factor is corporate venture capital. Also is let's say very attractive. Many corporations have venture arms and are investing in startups aligning with their strategic intent, like auto companies investing into EV startups or banks into fintechs, etc. So this additional source of funding helps to fill that gap, often in a more patient way. So strategic rather than purely financial return driven, and this dynamic should come back. Of course, there's a lot of caveats around corporate venture capital. But that's likely a commentary for a different day about how best to approach that and how best to look at that. But it's just interesting to note that is coming back. I think also maybe then just a quick note about the funding environment in general. I think banks in many regions, you could argue, is more cautious in lending. But this is partly due to higher capital requirements. Um, there were some recession fears, and I think that's probably still playing out. And then also just the source of capital. What source of capital is being used to fund requires the banks to be more conservative or more diligent in how they lend out money. And then you have the parallel to that, the private credit funds that in theory have stepped in to provide funding where there's a perceived gap. And these are your asset managers directly lending into companies, often to finance private equity buyouts or growth of size firms. And here too, in many cases, it's actually being facilitated or co-funded with banks as well. So these two ecosystems don't necessarily compete, but they definitely collaborate, or you've got a co-opetition in environment where there's a lot of collaboration actually taking place. Um, we saw Moody's and a few others also warn that this rapid growth in private credit does bring new risks. But in the near term, at least, it means that companies have alternatives to consider, or a different capital stack, or funding profiles to bring on board with various different risk profiles. But again, something to be cautious of. I think private credit, as we move into 2026, very well established. There's a club of private credit lenders might finance a big acquisition that traditionally needed syndication. Again, it doesn't mean that your traditional funders or advisors are not involved. It just means the sources of capital might be slightly different. So it really opens up a bouquet of additional funding. Also, you can see from the interest in I think private capital from LPs has also been strong because of the yield, and the higher in if we're looking for higher yield. So I think that asset class also has a very high level of dry powder. Um, and again, so all in all, I think we're sitting with corporates and sponsors has diversified funding sources. So your traditional equity and debt markets, plus your credit, your private credit, your sovereign funds, family offices, strategic investors, which again, I think generally means if a deal or growth plan is sound, funding is available, which I guess is the key message. But the important point is also around all of that: understand the risk parameters and understand what the implications of putting your funding structure together might mean. Of course, we need to also think about some contrarian factors. This is sort of optimistic about we are optimistic about where private equity and venture capital is going, but we need to also understand that there are some negatives or some cautionary factors to also consider. We mentioned valuation before, so there's always a risk of overpaying. If competition for deals start heating up, there's a risk that private equity might over leverage or overpay again, which could cause pain if economic conditions, if there's pressure or a downturn. And so funds will really need discipline to avoid that mistake of this later cycle exuberance. Rates are easing, but again, we know inflation could still surprise. So central banks could hold rates slightly higher for longer. We know that there is a reducing cycle, but still it's a little bit contentious still. So again, that could also keep the pressure on highly leveraged plays and make LPs less enthusiastic due to safer yields elsewhere. Of course, regulation. Private equity is facing some increased regulatory scrutiny, calls for more transparency on fees and impact of private equity on industries like healthcare, etc. There's nothing specifically imminent, but again, this too drastically changes the model. Doesn't necessarily change the model, but it's definitely on the radar around what regulatory and what the disclosures might need to be made. And then VC valuation and IPO markets. I think for VC, a lot depends on IPO markets staying open. And if for any reason IPO shut down again, you're going to have a bottleneck being created. So in conclusion, bringing this all together, the investment ecosystem for 2026, I think, is dynamic. It's much improved from a couple of years ago. And I think Reuters in an article, I think, summed it up quite nicely, and then said that, if inflation and trade tensions remain, um, although it remains, there is also reason for some very strong optimism because of these fundamental drivers. Economic growth, corporate profits are really in place. Your private markets are regaining momentum. You know, there's this sense of realism and optimism among investors as they enter the year, and then PE firms are adjusting to a more measured pace of after the frenzy we saw in 2021, and VC is benefiting from these stabilizing conditions, lower interest rates, and also a wave of innovation and R&D and AI driven innovation fueling the next generation of startups. What this means in practical terms for a corporate executive, I think there's active acquirers in the industry, so either strategic rivals or private equity. So the threat of consolidation or a competitor gaining an edge via M&A is real. Defensive and offensive strategies should be on the agenda or being spoken about. Opportunities to partner with or be funded by private capital. I mean, if a corporate needs capital for a spin-off or a big expansion or acquisition, there are private equity funds or even holdcos and investors eager to co-invest or finance these moves. And this is very similar for innovation. So tapping VC or either through corporate venture capital or other incubators that can accelerate this innovation, digital transformation. So again, a very interesting landscape also for us as financiers. And then, of course, competition for assets. If selling a division or seeking investment, the presence of both strategic and financial bidders could drive valuations up. Good for sellers, but if you're a buyer, be prepared to justify the price with synergies and growth plans. And again, caveating that, not now for this video, but we know that 80% of M&As fail to deliver the returns you thought because of overestimating synergies or growth plans or the complexity of integration. So if you're starting to do that, make sure the right capabilities are in play and the right processes are in play. It's key for executives to align any deal or investment with their long-term strategy. So it's not about getting swept up in the fever. It's your best performing companies are the ones that make regular acquisitions on a smaller scale and integrate them very well. So again, this highlights this consistency and execution over rather than being overly exuberant. So again, if you see transformative mega deals on the table, go back to your first principles. Ensure that it is truly strategic. Consider your geopolitics, your plan for integration meticulously. Start that very early, and question if more incremental opportunities could still achieve the same growth. So I think with those guardrails, 2026 can be a year of bold but intelligent deal making that sets companies up for success for the latter part of the 2020s. Thank you for listening, and we'll share some more thoughts with you in a future video.